You're listening to The Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. And please note, we are moving. Where? Noon on Saturdays, starting October 4th. So right now we're at 1 p.m., but in a couple of weeks we're going to be moving to noon.
We're moving to the prime spot.
Prime spot, exactly.
Prime
we got so
time.
popular, but prime time.
That's
We got
right.
so popular, they moved us.
High noon.
Okay, so I'm your host, Edward Brown, and I'm proud to have as my co-host, Mark Hanf of Pacific Private Money, California's fastest growing mortgage investment firm. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during each commercial break. Today's trivia theme is silent stars. So you have to go way back in time in the movies for silent stars. Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show, and television Comcast Channel 26 and AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. Today's special guest is Kelly Clemensen from Farmers Insurance.
Howdy, how's everyone?
Good. Excellent. Thank you for joining us. Now, I got to tell you, the reason that we have Kelly on, now, everyone knows that I'm an expert when it comes to life insurance and disability insurance. But when it comes to what they call property and casualty insurance, that's where I leave it to the big boys. And as it turns out, I had gotten in touch with Kelly because I have a building where I was just getting reamed with my insurance premium. So I did a little research and came across Kelly, and even though he's not from the San Francisco Bay Area, it didn't matter because we did this stuff, email and phone, and then decided, you know what, he's coming up here, so we're going to have him on because he saved me Uber money. That means lots.
It's lots.
Nice.
Of money.
All right.
So, Kelly, you're with Farmers.
Absolutely, yes.
That's a small
Yes.
company. I think I've heard of them before.
Yeah. Thank you, little carrier down in Southern California.
Yeah, only in Southern California. Yeah.
You're not the gecko guys, right?
No.
Those are the other guys.
Great commercial, along with the duck. Who's the duck? Affleck?
That's
Yes.
right.
Affleck, yeah, that's right, exactly. So now, you helped me specifically with my building, which is kind of ridiculous how much money you saved me, on that. But the average person, they don't own buildings, but they own their car and their house and all that.
Absolutely.
So we're hoping to give us a little advice. What is people have kind of, I think they've heard the term bundling.
Yes,
Explain
that's
a bit about that.
bundling. Insurance carriers like to have the complete package, and if they can do that, they feel like they have a better chance of protecting you properly. And also, since they have the whole package, they tend to like to give out discounts for being loyal, like loyalty, like anybody does.
Okay.
So they're willing to give out some discounts in that way.
Okay, and so what is the bundling? What is that?
Bundling just it kind of mounts as you put one policy with an insurance carrier. Once you put on another policy, they give you a discount for the first one, and they usually go both ways. Your auto home discount, and also with Farmers at least, they also give a discount for having your commercial policy with us as well. So
Okay.
the discount goes all ways. I don't know, how would you explain that, but yes.
Okay, but basically
back and forth.
more than just doing the car.
Yeah, exactly.
All right.
So Kelly, we were joking a little bit about the gecko and some of the other guys out there.
Mhm.
So obviously there's like the big 4 or 5, and we see all their commercials. A lot of competition. What is Farmers? What's their claim to fame? Or I mean, you're obviously a dedicated Farmers agent, and I have Farmers insurance. I mean, on my homeowners, auto, and rental property, and again, I take advantage of that bundling, which is absolutely great.
Right.
But Farmers, in general, what's the takeaway from Farmers versus some of the other big guys that you're competing against?
Well, Farmers is a large carrier, as we mentioned before, but they tend to like to carry your coverage so that you'll be protected, and in particular when the assets start to mount, when you get to be a little bit older and you have things, you need to protect them from what goes on in everyday life.
Like boats and
Yes.
motorcycles
Yes, all
and
those things.
snowmobiles.
Absolutely. Yes. Aircraft and moonmobiles or whatever you have. I don't think we have discount on
Spacecraft.
mobiles, but yeah.
But then Mark was mentioning also about umbrella. Now,
Right.
my umbrella only costs $20, so I get a new one every time it breaks. But we're not talking about that kind of umbrella, are we?
Protects you from different types of rainstorms, yeah.
Yeah.
Umbrella insurance extends over the package and just brings you more protection over your whole portfolio. So umbrella insurance it's relatively cheap because the likelihood of it getting there is somewhat small. But on those large claims, you're really happy you have one because it does extend over and above the limits you carry in your underlying insurance.
So what's a typical umbrella? So I know that a lot of underlying policies, it's common for them to have like $1 million limit or maybe a $1 million limit with $2 million aggregate
Right.
in a year's for claims. The umbrellas on top of that, and what are you finding is some of the more common umbrellas that your clients are buying?
We do umbrellas all the way up to $5 million at times. I've got a couple that are on clients that have significant assets and they're looking to protect those. Up to $5 million umbrellas. The way things are, it's not unusual to have. Well, let me rephrase that. It is unusual, but it's not out of the question to have claims like that.
So basically, it's like on the auto, you have typically what 300,000 is usually the.
That's the most typical one.
That's the most typical one.
Yes.
So if you get into a car accident and you cause more than $300,000 of damage to somebody,
Life and limb.
Yes.
Is
that's
that
right.
generally the idea?
That's
that
the
it
idea.
kicks
Yes. Right, and then you have an attorney after you.
Yeah,
So
really,
to
yeah.
avoid that, and attorneys are great, they're just protecting people, but to avoid that coming out of your pocket as opposed to the insurance company's pocket, which they have a lot deeper ones than most people have, that umbrella that's where it comes into play, is the umbrella picks it up after that.
Yeah, but if you hit somebody accidentally and cause great bodily injury, it's going to cost more than 300,000, and so
Yes.
that's the. I'm trying to think of like if any insurance on your car covers like $1 million, but usually it's only about 300,000, isn't it?
There's limits available higher than that, but that's the typical one that most people carry. You'd be surprised how often that turns up. Because that's what lease limits are required, and a lot of people carry that. They figure
Yeah.
lease companies are enough. So
Does an umbrella policy just extend your existing coverage, or is there additional like bonus coverages that are in an umbrella policy?
Yeah, they do cover what's called gray area coverages. Now, if I could
Well, that
explain what
sounds
the
nice.
gray area would be, then it wouldn't be gray. So
Yeah.
something that comes
Acts
up
of
that's
God.
not particularly excluded underneath on your underlying policy, then the umbrella can pick that up and pay for it.
They cover acts of God.
I don't know if we do that or not. I'm not sure about that one. I don't believe so. No, they
Yeah.
don't. They don't cover those type of things.
Now
no.
they're excluding terrorism and war and all that.
They do. Yes. Yeah.
Give us a little bit about before we cut to commercial break about the deductibles. What do you
Sure.
typically like to see? What have you found has been a good cost-effective?
Myself, as an insurance agent, I carry higher deductibles.
Yeah.
Because I just feel like giving money to the insurance companies for lower deductibles are causing more premium to go to them and more premium out of your pocket. Now, if you want lower deductibles, that's up to you. But in my idea is that the higher limits you carry on the bodily injury or in commercial, the higher limit you can carry on the commercial on the aggregate limits and on the per person or the per occurrence limit, the higher you can get that, the better off you are because the deductible, that's manageable. If you carry a $5,000 deductible instead of a $1,000 deductible, $4,000 not peanuts, but it's manageable.
Yeah,
And you pick a higher liability
You'll
limit.
save a lot of money
Yes.
on those premiums. Tell you what, we're going to cut to a quick little commercial break here. He was called the man of 1,000 faces. Who was he? All right, the first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. He was called the man of 1,000 faces. Who was he? Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money. When we cut to the first commercial break, we asked this trivia question about silent stars. All right, he was called the man of 1,000 faces. Who was he? Kelly.
My guess is Boris Karloff.
No.
No. Bad guess.
Lon Chaney Sr.
Oh,
Remember that? He
Chaney.
did Phantom of the Opera and all that fun stuff. Okay, now we are in the studio here. We have the pleasure of having Kelly Clemensen, who's a farmer's agent, and he's educating us about auto insurance and all kinds of things. Can you get into the specifics about like comprehensive and uninsured? Because a lot of people we hear these terms, but
Sure.
let's get the definition from the
Yeah,
expert.
comprehensive, collision, all these various auto policy traits that
Sure.
some of us don't really quite understand why we're paying for those.
That's right. Give us some
Absolutely.
advice.
Comprehensive insurance is described as everything except for collision. So examples, sometimes taking a key and scratching your paint, rock through the windshield, your car gets stolen, running into an animal, strangely enough, is comprehensive.
Really?
So those types of things
Well,
are...
hold on.
Yes.
Bambi.
So I'm driving my car and
If
I
you hit
hit, and I
Bambi,
hit
yes,
Bambi.
that's right.
That is comprehensive?
Yes.
Even though it
Exactly.
happened during an accident?
Right.
While the car was moving?
Yes, amazingly enough.
Really?
And the other thing is if a package falls off of a truck, comes in front of your car, and the package is still moving, that's considered comprehensive as well.
If it's not moving?
If it's not moving, then you hit it and it's collision. Yes, that's right.
Oh,
And
interesting.
Comprehensive, generally speaking, doesn't go against your premiums, whereas collision does. If you have a collision, it's your fault. That's going to cause your premiums to go up, more than likely.
Now, do you have to have both?
No,
No.
you don't. Now, like, if you have a financial institution that's insuring your car, or excuse me, you're making payments to,
Yeah.
then they're going to want to have both. But you don't. If you don't have that, you don't have to have both. No.
And today, does the insurance? Let's say I buy a car, and I have a loan on it, so they're going to require me to have insurance.
Yes.
Can I choose the deductible?
Yes, with most companies you can, and you can
Okay.
choose a higher one. Because
Alright.
generally speaking, insurance companies guarantee a deductible to the financial institution that's different than what yours is.
Okay, and usually they'll make you take out the high limits, 300,000 or whatever.
If your car's leased, yes, they'll do
Okay.
that.
Now, in some
Right.
cases, like when I bought a car for all cash, because I don't buy super expensive cars, I totally didn't even get collision.
It's not a bad idea. It's
I mean,
if you can
yeah.
carry higher liability limits, I'm a firm believer that's the most important place
That's
to carry
exactly.
coverage.
That was my whole
Yes.
idea. Is that if I do something stupid in my own car, that's my own fault, and I should pay for it. If someone else,
There you
if someone else hits me, that's their problem. But now, a lot of times, there's people running around out there without insurance, and so what do we have for that?
We have uninsured motorist coverage for that. Not only for injuries to yourself, but also damage to your car as well.
So where does the medical
So-
part come in? Because there's also medical on top of that,
Right.
isn't
And medical payments are confusing. They can be, a lot of people consider that's what's going to pay for the person in the other car. Medical payments, that's not what they're for. Medical payments are free people in your car, mainly family members. So your bodily injury limit covers for injuries in the other car. The medical payments cover for your injuries in your car.
It doesn't matter who's at fault?
Medical payments, no. It's a no-fault coverage.
Okay.
What about earthquake? Does Farmers provide earthquake, or do you have to get that from a...
Only if it happens on a Tuesday and it's raining. No, I'm just kidding. Go ahead.
Actually, Tuesday, very late. No, actually, Farmers does not provide it in and of themselves. There's a company that came into existence when the Northridge quake happened in '95. It's called California
94.
Earthquake Authority, '94.
94,
Yes.
I remember. Because it happened on my birthday.
Ah,
Yeah.
okay. So that bred a new insurance company they call the California Earthquake Authority.
You know what? And the thing is, it's like a $25,000 deductible.
Huge
and
deductibles,
Yeah,
yes,
and
yes.
it's like, yeah, and the premiums are so much. You look and you go, I don't know if it's worth it.
Depending on where it is, the premiums can vary drastically based on where you're at. Yes, that's right.
Speaking of premiums, my experience is that insurance premiums as a rate per like 100 or 1,000 of coverage they tend to go up and down year to year depending on God only knows what claims experiences,
Claims, yes.
storms, etc. How are rates now?
In particular, if you're in an area that's a fire hazard right now, the rates have gone up pretty significantly. The insurance companies have lost significant amounts of money on homes where there's brush areas, and you'll see that those rates have changed. I'm not talking anything new to those that live in those areas. They've already gotten them.
Because we live in an area where the fire marshal specifically comes and kind of tells you, hey, this is what
This is what's happening.
this is what you do. Get rid of this stuff 10 feet below and 25 feet around your area.
Most people have gotten fire department surcharges for living in areas that are brush areas,
Yeah.
and insurance companies have followed suit because they've lost a lot of money in those.
But aside from that, are insurance rates down or up year over year for the average insured?
Occasionally they go down, but it's not very often. Generally speaking, they go up because the cost of repairing vehicles almost never goes down. Your car might get older, but the parts on it to replace it, generally speaking, they go up, and the labor usually goes up.
That's a good point. So even if you
Yeah.
have a 1974 Pinto, well, actually, the parts trying to find parts of that would be very expensive.
Good luck.
Yeah.
Yeah, really. But the labor part of it, you're right. That part doesn't
Doesn't
really
change. No.
Wow. Any other advice you want to give us?
Well, there's some minor coverages on auto insurance that's really nice to have. Uninsured motorist property damage
Yeah.
That's a coverage that pays for your car in case an uninsured motorist hits you and damages your car. But even if you don't carry coverage for the car itself, you can get some coverage with that coverage as well. Glass deductible buyback's nice to have. Most insurance companies will fix the little pits that you get from the trucks that kick rocks up on your windshield.
Oh, interesting. Okay,
yes,
so
they'll fix those. Most companies will fix those for free.
Really?
If you carry the glass deductible buyback, they'll fix those
glass
for free.
deductible buyback. Okay,
Right.
because ordinarily that would be like a comprehensive potential
Right,
situation. But
yes.
if you don't have enough,
If your deductible's too high
yeah,
for your
yeah,
windshield,
exactly,
then
yeah.
you're fixing it yourself.
because
right.
windshields generally are not that expensive
Right.
anymore.
And again, that's one that doesn't raise your insurance premiums, at least with farmers it doesn't.
Oh, that's neat.
Yeah.
I like that. So again, I had Kelly on here because I just was flabbergasted as to how much he was able to save me on insurance on a building I owned. It was incredible.
How much of your business is commercial versus residential?
Right now, I've been concentrating on the commercial part, simply because I found a way of contacting folks like Edward, and that hasn't been easy with the type of coverage he has. But I found a way to do that, and it's gone actually very well. So it makes it so I can come up
Yeah.
to Northern California and enjoy your wonderful weather up here, as opposed to the 100-degree heat down south.
Well, what happened was, I got this postcard, and I was thinking, okay, well, yeah, of course I've heard of farmers, but I gotta just call the guy just to see if he really can help me. And then, sure enough, he got back to me and said, "Yep, this is what we can do." I said, "Are you serious?" I go, "Really, really, really? Cross your heart, really?" And he said, "Yeah." And so I wrote a check out to the Kelly Clemensen Fiji Island Fund. No, just kidding. No, I just wrote it out to farmers, and sure enough, we're covered. Well,
Certainly
like I said,
accomplished
you were the real deal. That's why I had you on, because you really did help me. Okay, Kelly Clemensen, thank you very much for joining us. Stick around if you want to kind of hear about some real estate
Sure,
stuff.
love
Mark's
to.
got some really interesting things here. Okay, tell you what, we're going to cut to our second commercial break here. The theme is Silent Stars. Before Errol Flynn, which, by the way, people say I look like Errol Flynn. So I've also been told I look like Robin Williams prior to him passing. But before Errol Flynn, he was synonymous with sword fighting roles such as the Thief of Baghdad and the Mark of Zorro. Who was he? And don't touch that dial, because the best of investing. I'll be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, California's fastest growing private lender. And when we cut to the first commercial break, we asked this trivia question about old movie Silent Stars. Before Errol Flynn, he was synonymous with sword fighting roles such as the Thief of Baghdad and the Mark of Zorro.
You've stumped the co-hosts.
Uh-oh. Douglas Fairbanks Sr.
Oh, of course.
Okay.
I'm just not old enough to know that.
You never saw any of these old
Now I
movies?
feel young.
Buster Keaton and all that stuff?
No, not really.
Okay. All right. Well, the last one goes back to 1620. No, it's good.
Little Rascals I used to.
Yeah, that's true.
That was black and white.
Yeah, so I enjoyed that very much. Okay, so Mark, first of all, we got an email here from a listener that says, if I only want to invest in your fund for a short time, say a year, does it still make sense to invest?
Okay, a little background for anybody who's listening for the first time to the Best of Investing. I'm Mark Hanf. I'm a broker and president of a company called Pacific Private Money. We're located here in the Bay Area, and we provide we have two clients. We provide privately funded real estate loans for real estate investors and consumers. Basically, we are a non-bank source of real estate financing. And the money we use to finance those loans all comes from private individuals, many of them living right here in the Bay Area. In fact, the vast majority of our investors are Bay Area residents. And so one of the investment programs that we have for Bay Area residents is our mortgage pool fund. We call it the Pacific Private Money Fund. And we launched it in 2013 in response to the fact that we had too many people calling our company and wanting to invest in the notes that we originate. And we originate fairly conservative loans. We don't do 80% bank financing. We're generally 70% or less. In fact, a lot of the loans we make are 40, 50, 60% loan to value. Again, these are oftentimes short-term, fast loans that the borrower needs money for a certain situation that's come up, and the banks just aren't able to respond in time. So there's a strong demand for hassle-free, non-FICO based, non-bank financing, and it's a very quickly growing market. We founded the company in 2008. We've done over 750 loans, totaling over 175 million, with only 2 foreclosures in all that time. So that gives you a little bit of an outlook on the safety of the type of loans, or at least the security certainly of the loans that we've been making. And so we've got a lot of very, very happy investors who've made a lot of money over the years. 8% or more is the typical return that our investors have been receiving on their invested funds. And so when we launched the Mortgage Pool Fund, it was a way for the average person who's not a sophisticated note investor to be able to take advantage of the strong demand for private money, which used to be called hard money. It's still called hard money in some circles, but really it's a private money loan. And the market rate for private money loans in the Bay Area right now is anywhere from 9, 10, sometimes even 11% for, again, generally a short-term loan. It's not intended to be long-term financing, and people need it for any number of reasons, of which we've elaborated over the years on this show in great detail. So the question was, for those who want to invest in our fund, if I only keep it, is it worthwhile to invest in the fund even if I only keep the money in for a year? Well, why? What's behind that question is that we have a 2-year minimum request for people who invest in the funds. It's designed to be a no-load fund, meaning there's no fees to you to invest in the fund, and there's no fees for you to take your money out of the fund if you keep it in for a minimum 2-year period. So no load, no fees. However, and we designed it that way, by the way, because we don't want people to treat it like a money market account. We have a real business model. We make loans. We don't want people to put money in and then take it out in a few months. It's not a parking place for money. It's an investment strategy for people who are looking to boost the yields that they earn on their savings and retirement accounts. So, what happens if you pull your money out early? Well, we do have an early redemption fee, but it's not punitive. So in other words, it doesn't take away, or it's not designed to take away all of the earnings that you would have made in that period. So, for example, we have a scaled or a stepped prepayment penalty. So within the first 6 months, if something happens, you got to take your money out, it's a 5% fee. That fee goes into the funds. The shareholders, the members of the fund, they benefit from that. We don't personally, the brokerage or myself, we don't personally benefit from the early withdrawal fees. The next 6 months, months 7 through 12, it would be a 4% redemption fee. Month 13 through 18, it would be a 3% redemption fee. And then in the final 6 months, if you got to take it out just before 2 years, it's only a 2% redemption fee.
Okay, so when someone says that they invest for a short time, say a year, so let's call it a year and a day.
Yeah.
Then the
Then it's
prepayment rate is
3%.
3%. But right now you're paying over 8%.
A little over 8%. So if you were a growth investor, and our growth investors who are not taking distributions are getting about 8.5% right now. So after 1 year, if you pulled out, that 2% charge would come off that 8.5%. The 3% charge would come off the 8.5%. So your net
5.5.
Yeah.
Okay, so if you look at a conservative investment, to earn 5.5% net, because there's no fees, and that's even after the prepayment penalty, that's much gooder than the bank, as they say.
Well, like I said, it's not designed to be punitive, and so it's just we designed it so that people would have an incentive to keep their money in. But again, we don't want stuff happens, and I know that there are some people who have invested with us who are active real estate investors, but weren't finding what they were looking for, so decided, well, I'm going to invest in Pacific's fund, but if something comes up that's too good to turn away, I'm going to go ahead and pull the money out.
Sure.
In fact, they haven't done it yet, but I happen to know that one particular investor who's an active real estate investor, I'll get the call one of these days to say, hey, I got to pull my $100,000 out.
So in a sense, from his standpoint, it is kind of parking the money.
Yeah.
But he's parking it only for a short time.
Right.
Not bad, not bad.
So for more information, for those of you who want to find out more about how a mortgage pool fund works, and more specifically how the Pacific Private Money Fund works, we have a website specifically for the fund. It's on the web at pacificmoneyfund.com. Of course, all one word, pacificmoneyfund.com. And when you're there, you can get a bunch of information.
All right. Now, we're going to cut to our third and final commercial break. Here's the trivia question. When we come back, I'm going to do two things. One, I wrote an article that I got published that a lot of people don't know where it is. And if you email Edward at bestofinvesting.com, I will, for free, email you this article. It's about analyzing real estate with all kinds of sophisticated, fancy stuff, which I think the audience will appreciate. And then our co-host Mark Hahn has a book coming out. We'll let you tell the audience about that too.
Indeed.
So here's our third final trivia question. Again, the theme is silent stars. Which silent star actress was called America's Sweetheart and the Girl with the Curls? Welcome back to the Best of Investing. Last time, I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money. Here is the third final trivia question. The theme is silent stars. Which silent actress was called America's Sweetheart and the Girl with the Curls? In unison.
Shirley Temple.
Wrong.
I think you're wrong because she's in the talkies.
Wrong again.
She's in the talkies,
Yeah,
exactly.
it's not silent film star.
Mary Pickford.
See,
Girls,
again,
all
I'll
the
tell you, I'm
girls
too
that-
young for these questions.
Row for 3, I think.
That's right.
0 for 3, that's right.
Not bad at all.
We're not going on vacation.
No.
Okay, so
We're not gonna be seeing the resort.
so first of all, I was telling the audience when we cut to the break that I wrote this article that talked about analyzing real estate and it has to do with expense ratios and cap rates and all kinds of debt service coverage ratio. And actually, I got some compliments on it. People thought it was pretty good. So what I'm going to do is if anybody wants to email me, Edward at bestofinvesting.com, and just say, please email me the article, I would be delighted to forward that to you. And but Mark, before we get into the book that you wrote, off air, Kelly asked a question I think it was good to ask on the air.
Sure. The types of mortgages that Mark was talking about, I was just wondering if those are mainly directed towards folks that have had unfortunate things happen on their credit.
Well, you'd think so because, again, when most people think of hard money or private money loans, they think, oh, yeah, those are seconds you make to people with bad credit, or not even necessarily seconds, just a loan to someone with bad credit. I can't tell you how many people we make loans to with 800 credit scores, high 700 credit scores. So clearly, it's no longer necessarily loans to people with bad credit. Now, we do get loan applications from people who can't get bank financing because on their credit, which might not necessarily be bad, by the way, I can tell you that I see credit reports every day that with scores in the 700s, but they can't get a bank loan because 4 years ago or 5 years ago, they had a short sale, a loan mod, or a foreclosure, which now their credit score has recovered, but as far as the bank's concerned, 7 years haven't gone by yet,
Yeah.
so we're not able to make you that loan.
I talked to my banker. Now, I had not been in that situation, but I asked him, I said, I've heard this, that, if somebody's trying to negotiate the principal on their loan, on their house, or any other loan, that you guys are just turning them away. And he says, yeah. He says, doesn't matter what the credit score is. Because the way they look at it is, if you did it to us once, you're going to do it to us again.
Well, and that's exactly right. And so that's one example. But the other example has nothing to do with credit or income or how they look on paper, but it has to do with speed. Now, in this market we're in, and we've been in this market now for a couple of years, where there's a lack of inventory. And so the way a lot of people make offers on a home that they really, really, really want to get, whether it's to move in for themselves or for investment purposes, is oftentimes the offer will be very aggressive in terms of maybe it will be an all-cash offer, a no contingency offer, and even a quick close offer, where it's not as common now for there to be a 30-day or even 45-day escrow. It's not unusual for there to be
contingency.
Or contingencies, right. Oftentimes, in order for you to get in the front of the line to get that property, you have to have basically a no contingency, all cash, close in 14 or 21 days. Now, what happens if you actually don't have all that cash? And I will tell you that there are people making offers on real estate every day that say all cash, but they don't really have all cash. They intend to go to a company like Pacific Private Money and get a fast, no hassle, private money / hard money loan to close that transaction.
Because
and we do that all the time.
Yeah, so from the seller standpoint, it's all cash.
Mm-hmm.
Right, because there's no regular bank in loan Yeah. they
Well,
don't
it used
carry
to,
paper.
right, and it used to be back in the day when, we were in a normal real estate market, and we're looking forward to being in one of those again one of these years. But you could make an offer on a home, and it would have a financing contingency, and it would have a sales contingency of your existing homes. You could ladle the offer you made with all of these contingencies. Well, I mean, that hasn't been the market for a long time, and so we get a lot of phone calls from mortgage brokers who say, I have a client, he needs to close, it's got to close by the end of next week or in 2 weeks, and I can't get him bank financing that quickly, but I will be able to bank finance him out very shortly thereafter. Can you make a bridge loan, which is normally what it's called in the business? And so we are very, very busy these days. In fact, in 2014, bridge loan has been our #1 product. It's been the most popular product, and so we have stellar people. In fact, listeners of the show will recall we told a story about one borrower who works for some little company by the name of Apple here in the Bay Area that
heard of them.
couldn't get a loan to close quickly enough, and he was about to lose a $50,000 deposit that had gone non-refundable if he didn't close by Friday, and I got that loan request on a Tuesday. So we don't like those fast closes, but we'll do them when we can, and we've got the ability to do that more often than not. So. Thank you.
Okay, so first of all, do you have a deal of the week? Anything exciting you're working on specifically you want to share with us?
Well, I know our time is a little bit limited. We're running towards the end of the 4th segment here, and I'd really love to talk about the book that I wrote and is about to be published. And so in my business as a private money lender, I do actually work with a lot of real estate investors. And oftentimes the real estate investors will call looking for 100% financing because they took a course that told them that they could still do no money down. Well, the reality, and oftentimes these guys would call and they'd say, hey Mark, could you introduce me to some of your private investors, some of the people that invest in your notes? Or they might say, how do I find my own private lenders? And so after getting that question, about 1,000 times and basically saying, well, no, I can't share with you my investors because A, I don't know you, and B, I'm not going to refer you and then have you have it be a disaster. So, so I decided, well, how could I share information with the real estate investing public that would help them to basically find their own private lenders, their own equity capital. And so I came up with a title of a book and wrote a book called The Insider's Guide to Attracting Private Money.
Good.
And the essence of the book, and there's an accompanying video series that I also produced, which will be also released in the next 30 days, that talk about how to be attractive to people with money to invest. Because there is billions of dollars in the Bay Area alone looking for yield, and a lot of those people will invest in real estate if they could find the right people to invest with. The challenge with most people who call me on the phone and are looking for an equity partner or an investor, a cash investor, is that they haven't done the homework. They haven't created what's called a credibility package, and that's what I go into in great depth in both the book and the video series. Is what is a credibility package? How do you create one? What should it say? What should it look like?
So being more attractive is not just putting on high heels and more makeup. I just want to make sure I understood that correctly.
So I'm very big on attraction versus promotion. Attraction, we all know what promotion is hey, here I am, buy my stuff. Attraction is, here's what I can do for you. So part of becoming attractive to private money is presenting yourself like a real estate professional to someone with capital so that it gets them to know you, like you, and trust you. Because I tell you right now, after been in real estate for almost 35 years and having raised millions and millions of dollars, people will not invest with you unless they know you, like you, and trust you. And so there are keys to being able to create that, and that's what I go over.
First impression, too.
Right, and absolutely. So the Insider's Guide to Attracting Private Money is going to help you become attractive to people with money to invest. And
when does the book come out, and how do people get hold of it?
We're launching it probably at this point. It's September. It's probably going to be sometime in October. We're still getting everything set up.
Okay, on future shows you can.
It'll be available on Kindle and downloadable. But right now you can sign up. We have a website called attractingprivatemoneybook.com. Go to attractingprivatemoneybook.com. comcast.com and sign up for the release.
Great. All right, Kelly Clemensen,
Yes.
Farmers Insurance. Thank
Yes.
you very much for
Awesome.
joining
Thanks
us.
very
We're going
much
to
for
cut to
inviting
our
me.
thoughts for the day here. The University of Minnesota is older than the state of Minnesota. How does that work? I don't get it. And 10 dimes, 4 quarters, and 2 half dollars have the same mass. What a coincidence. They each total up to $1. I thought that was kind of interesting. All right, tune in next week to the Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. 7 seconds to spare. Welcome back to the Best of Investing. Of course, on the sports show, Vern likes to tell me, "Don't say that. Just say we're still here." You know. Anyway, okay.
We didn't go away.
Yeah, I'm your host, Edward Brown, and along with my co-hosts, Mark Hanf and Patty Cohen. When we cut to the first commercial break, we asked this trivia question: in baseball, who did he beat out? Pete Rose became the all-time hits record leader in the 1980s. Whose record did he beat? So who had the all-time hits record prior to Pete Rose? Answer? Tyrus Raymond Cobb.
It was Ty Cobb.
Yeah.
Jeez, I was going to say Ty Cobb. I should have just gone with my gut.
And not Tyrone, but Tyrus.
Tyrus?
We go with just Ty Cobb, it's fine.
Yeah.
I want to talk a little bit about Detroit, their bankruptcy. I read a little article that said that creditors could possibly get 75 cents on the dollar compared to 10 cents on the dollar if they were allowed to sell the art that is in the museums in Detroit.
Are you kidding?
So
Wow.
here's the
Wow.
kind of the interesting question. You know, do you take the culture out of the city by letting them sell all of what? And I don't even know what kind of art they have. I'm gathering, it's probably famous sculptures and other paintings and stuff to satisfy the creditors. I mean, in theory, if it's owned by the city and the city owes the money, then in theory you should be able to sell it and.
Well,
pay
if you're a
off your
creditor,
debts.
you're probably saying sell. But
I know, and that's a big
Everybody
difference.
else.
75 cents on the dollar compared to 10 cents on the dollar.
Huge.
Yeah.
Yeah.
I mean, if I'm a creditor, I don't want to get 10 cents on the dollar, you know?
Right.
Just give me that Mona Lisa. Oh,
Yeah.
no, that's in the Louvre. All right. So, anyway, that's just something to ponder there. Okay, so a couple of emails, interesting here. Mark, one comes in here and says, do you ever do a loan where you don't get title insurance? You have to explain that to
So for new listeners, my name is Mark Hanf. I'm broker and president of Pacific Private Money. We are real estate lenders, non-bank real estate lenders. So we make loans to individuals, real estate investors, contractors, rehabbers, basically people that are unable to get financing from a bank. There really is, though, for all practical purposes, though, there's no real difference between a loan that we make and a loan that a bank makes, with a couple of exceptions. One being the interest rate we charge is higher because we're using private capital as opposed to the free bank
The free money,
Yeah, the free money
the
that the
bank
government
gets,
prints for
yeah.
the banks. And then number two, the fees we charge are generally higher too. But that's on the not so great side. On the great side, we're very easy to get a loan from, and we're very quick. And so and there's a lot of demand for quick and or easy capital in the Bay Area here, and we serve the Bay Area community. We make loans locally. We're based here in the San Francisco Bay Area, and we love making loans to flippers, rehabbers, contractors, and now even consumers. We started making consumer loans in 2014 to people who were in contract to buy a home, and for whatever reason their bank either is not able to close on time or can't close at all. So we call that product a consumer bridge loan, where we'll come in last minute oftentimes. In fact, I got a call this week again from a mortgage broker who said, can you close a client by Friday? And so that's awfully quick for us, especially in a short week.
Don't you just
But
love
we
that?
did it.
Good.
So, and we charge for that, that emergency fund, and we helped a person buy a lovely home in the gated community of Fairfield. and saved their deposit from losing their deposit. So again, there's a lot of times where you would resort to a private money real estate loan, which has been called a hard money. Same thing, hard money, private money real estate loan. And a lot of them are for reasons you might not think. Obviously for a contractor or a flipper who oftentimes doesn't qualify for bank financing because they don't either have the financial statement or provable income because they're self-employed. Sometimes it's because they have dinged credit. These are all various reasons why people aren't getting bank financing today. But another one is just because with all the new Dodd-Frank regulations, they've actually made getting a bank loan a lot harder in 2014, 10 times harder than it was in 2005. I mean, my gosh, it's just the pendulum has swung completely the opposite direction, and now it's harder than it should be to get a bank loan, where in 2005 it was easier than it should have been to get a bank loan. So unfortunately, that's kind of the nature of the way government or things tend to work when government meddles. So that's a little background into what I do. And so at Pacific Private Money, we've made over 750 loans since 2008 to using private capital. So the question was, do you ever make a loan and without getting title insurance? And the answer to that, the quick answer is no. We never make a loan without title insurance. More specifically, we never make a loan without getting a lender's policy of title insurance. There's actually two types of title insurance when you buy a home. If you buy a home all cash, you're normally still going to buy title insurance because it's an insurance policy that basically ensures that the seller
Really owns the house.
really owned the house and has the right to convey it, and that you now own it and have the right to live there. That's a owner's policy. A lender's policy is a separate policy that's required by all banks and by pretty much even hard money lenders and private lenders will require a lender's title policy, and that ensures ensures my investors, my private lenders, that the loan they made actually is in first lien position, and that they have a right to foreclose on that property if the borrower doesn't make payments. So the answer is we always require title insurance. We don't do any types of loan transactions without the whole transaction being handled by an independent escrow company. We don't typically handle the funds of our private lenders. Usually that money is wired directly from their account to the escrow company. So there's a lot of third-party safety and protective measures built into the way we conduct business. And so we think our loans in most cases are actually better and safer than a lot of bank financing, because we usually don't go over 70% loan to value on our loans, where bank financing regularly goes to 80%.
And it's unfortunate you can't just trust sellers that
No.
they say, sure, I own this free and clear. There's no debt on there.
Well, you can buy and sell real estate on a handshake if you want. It's just not recommended.
Right.
Yeah, that's true. Tell you what, we're going to cut to a quick commercial break. When we come back, we have a very interesting email for Patty that discusses about waiting or not waiting in lowering the price on a listing should it not sell quick enough. Okay, so here's our second commercial trivia question. Again, the theme is baseball. Who did he beat out? Joe DiMaggio won the MVP in 1941 by hitting in 56 consecutive games. Who did he beat out for the MVP, who had an incredible batting average that year? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. In 1941, Joe DiMaggio won the MVP by hitting in 56 consecutive games. Who did he beat out for the MVP that year, who had an incredible batting average? All right? And when we return, this interesting email for Patty. So stay tuned, listeners, to The Best of Investing. Hey, I know you.
You do.
No, that's me. I know me.
I need to know you.
Well, welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Humph of Pacific Private Money, California's fastest growing private lender, and Patty Cohen of Pacific Union Realty. When we cut to the second commercial break, we asked this trivia question about baseball. Who did he beat out? Joe DiMaggio in 1941 won the MVP by hitting in 56 consecutive games. Who did he beat out for the MVP, who had an incredible batting average that year?
Stump me again.
Here's a hint. He batted .406, the last hitter to bat over 400.
Ted Williams.
Ted Williams. That
Ooh,
is
good job.
correct. Mr. Kramer from behind the camera. Very good. Okay, Mark, you were going to... hold on. I'm sorry. We're going to get to Patty time. Are you saying about your article that you're going to bring up?
Not party time.
Same thing.
Same thing, that's right. When you deal with Patty, you're dealing with a party. So, for Patty Cohen, in your opinion, how long should you wait before deciding to lower the price on a listing?
Yeah, it's a great question. It's very hard to determine. Honestly, anywhere from before you even put it on to 45 to 60 days. So the 45 to 60 days would be, over 3 million, 4, 5, 6, 7, 8 million, where there's, it kind of depends on how broad or narrow the demand is for that particular property. But if you've got, say, a $5 million property and you don't get much action on it in a month, it's okay, or a week, that's okay. So again, and then the other side of it is, before it even comes on the market. I know when I do a little, put the temperature in the water on a new listing, if I don't get any feedback from my network of top agents, I'm like, we're off here somehow. I mean, if I don't have, in this market, if I don't have people beforehand going, can I get in before you put it on? Are you accepting offers before they go on? If I don't have that, I get a little nervous, believe it or not. So in that case, if we don't have offers within 5 or 6, 7 days, we're off on price. It's just as simple as that.
Wow.
And people say, well, it takes some time. Well, let's say it's $1.5 million property. Well, if it was priced at $1 million, would it go in a minute? Well, of course.
Well, it depends on how you market it. I mean, you have to blast it out to let everyone know, right? Be it a broker's open or just, if nobody knows, then...
Well, if true buyers are working with top agents in that marketplace.
Good point.
And when I whisper in the ears of those top agents that usually have buyers for that kind of problem, and they're yawning, we've got a problem.
Yeah. So now when they say, we want to get in before, or are you taking offers ahead of time, they have walked the property and they just say, I know I've got a
Sometimes
client.
they haven't even seen it. Sometimes I've got the coming soon sign up and they don't even know. But they know in that neighborhood they've been beat out 20 times and they're ready to step up. And sometimes preemptive offers in that case are good.
And when you get into the stratosphere of, $8, $10, $20 million houses, who even knows what the right price is?
Exactly. That's a different category.
Okay.
But I'm just talking about your bread
That's
and
Mark
butter.
Conf category. Sorry, go ahead.
Not yet.
Getting there, coming soon. Yeah.
Yeah.
But when you're just talking about, the couple trying to squeak in, here's the buyer profile. Young couple from the city, about to have kids or has a 3 and 4-year-old, and they are just trying to get into Marin, get in the school district, and they have lost, and there's tears, literal tears. They've lost properties over and over and over. They are going to be bird dogging those areas.
No, fair enough.
Or they're trying to get into the peninsula or whatever.
Well, I teased Mark about, that I said if I had his money, I'd throw mine away,
Patty, how often are you the one or the realtor deciding what to list the price at versus the owner of the property telling you, I want, $1.5 million for this house. That's what I want.
Well, it's a good question. I mean, honestly, the more sophisticated the seller, the more apt they are to listen to the agent. The more sophisticated the seller, the more apt they are to hire an agent that is competent. So you often find brand new agents listing overpriced listings because the sellers are saying, this is what I want.
Well, I find it kind of amusing when you'll drive a neighborhood and you'll see a sign from a real estate company you've never heard of, and they're 4 states away.
Right.
And you're wondering, they have no clue.
Well, that's
at
usually
all.
someone related to the owner of the property, I
Often.
would guess.
Yes.
Well, funny enough, we had my brother-in-law's wife, one time when she found out we were thinking of selling, and she lived in Virginia, and she was going, well, I don't understand. Why don't you list it with me? I said, well, are you going to come out here weekly and show the house?
Right. You're going to move here, really.
So there's a listing in Belvedere, and I only know about this because there was a loan application that came my way recently. and the house has got a great lot, great view, and it was originally listed at $28 million
That's a great fat price too.
Mm-hmm.
a couple of years ago.
I remember it,
It's
yeah.
been on the market. It's now down to $8 million,
Yeah.
and it still
Wow.
hasn't sold. So
What's wrong with it?
it's just really, you're probably familiar or
Yes, I
know which
am.
one I'm talking about. So it's interesting. I wonder how they came up with that original price. If
Yeah.
that was just the seller saying, well, the house right down the street just
Yeah.
sold for $25 million, so let's just see what happens. Who knows? And
Yeah.
How many square feet is it?
I don't know. I don't have any of the
It's huge.
details.
I
I
forget.
mean,
Yeah.
they would try to give it 10,000 a foot or something
Yeah.
ridiculous.
But
And it comes down to like how much is view worth,
Yeah.
I mean, I know what you're talking about, and sometimes the issue is that it's so shop worn, and it's a masterpiece could be perceived as a masterpiece if it's priced correctly, but a masterpiece that starts out in the stratosphere
Yeah.
is going to be just looked at as unworthy and undesirable.
Well, can you imagine if you were the person who put in an offer, let's say of 25 million,
Ah.
and got the house, or if you put in 25 million and they said no, and they go,
phew.
oh, we could have 25 million.
Yeah, yeah,
Well,
happens often.
and that's just, as you said earlier, Edward. That's just the crazy part of the market is I think anything over 10 million, in Marin anyway. In some markets, be anything over 2, 3, or 4, or 5 million. But in that whole Tiburon marketplace, it's when I hear people tell me. In fact, I did a loan application recently for someone who told me, "Oh, we're definitely going to get." When we put it on the market, we're going to get something in the teens. And so told me I would. And and I did a review of that market, and I ended up making the loan, but my internal valuation was closer to $8 million, and I would bet $1,000 that he doesn't get anywhere near 10 on that. Certainly not 13 or 14 that he thinks
So
he's going to
you
get.
thought it was worth 8 million. How big was the loan you made?
I don't have the numbers for that. Again,
Oh,
it was
okay.
it was a low enough LTV that
Like
it didn't
3
matter.
million or
It was
something.
well below 50% loan
Yeah.
to value at 8 million, regardless of
Yeah.
his belief that it was going to be.
By the way, there's
sell
no
for
such
some-
word as irregardless.
That's true.
I
I
teach
actually
them
know
about
that.
that.
I don't know why I did that.
That's
Apologize for that.
That's from the Department of the Redundancy Department.
Right. Irregardless.
Regardless.
Yeah.
Irregardless, yeah.
But it just sounds like it should be a real word.
Yeah.
That's like the same thing. I think I've teased Kramer here. There's no such word as height. It's just height.
Exactly.
So there's your education in English today.
Absolutely.
I tell you what, I want to get into this article when we come back from break because it was kind of an interesting article about some dolphins. Flipper. Oh no!
I saw
oh,
dolphins out at Stinson Beach over the weekend.
Did you really?
Oh, nice.
How far
Yeah.
out were you?
No, we were just at the beach. In fact, I've been about to Stinson Beach the last 3 weekends in a row, boogie boarding with my 13-year-old
Oh.
daughter, and every weekend we go out there, we've seen dolphins, the
Really?
blackfin
Wow.
dolphins that swim
Wow.
back and forth, and seals from the beach.
Not sharks.
Not sharks, no.
Okay. See, I'm
Fortunately
all
for
ready.
the
If I see a
surfers.
shark, I got my fist pumped, and I'm going to start pounding on them. I know the thing is they come up from underneath, so you got to kind of watch out about that. But mentally, I'm prepared.
Oh my goodness.
Because if you hit them hard, they don't want to be disturbed, either. I mean, get
The surf
out of
shops
way.
sell a shark repellent sticker, which is basically a picture of a zebra, and they say that studies have shown that the image of a
stripe.
zebra, the black and
The
white,
black and white stripes, I've heard that.
scares them
Really?
away. I have
Well,
no idea if it works or not, but
I-
you bet I got one on my boogie board.
Yeah. I thought it was the same thing where it's like they used to sell wetsuits because there was some kind of snake apparently that is the sharks don't like this certain snake that kind of like looks like a
Sharks and snakes in the
coral
same
snake or a king
Wow.
environment,
snake.
huh? I don't know about that.
Yeah. I thought it was a sticker that just said, "Please don't eat me." Okay.
Not tasty.
Not tasty, exactly.
Try the other guy.
That's right. You know that joke about the guy. Two guys were in the woods, and one they see a bear,
Yeah.
and one guy starts running really quickly, and the other guy really quickly tells him, he goes, "You can't outrun a bear." He goes, "I don't have to outrun a bear. I just have to outrun you."
You.
Mark, share that article about flippers.
Well, actually, it was 2 articles. So last weekend in both my local paper, the Marin Independent Journal, as well as the Bay Area's newspaper, the San Francisco Chronicle, there were articles about flipping. And, essentially the gist of both articles were Is there still money to be made in flipping? Is flipping basically, has it come and gone as an opportunity in real estate investment? And when I read articles by people who are not real estate professionals, you have to take a lot of what they write about with a grain of salt. Although they did, interview various people in that business. First of all, whenever I see the term flipping, I can't help but think that it has a negative connotation attached to it, because really, these people who are real estate investors that are being called flippers, they're essentially either contractors or rehabbers, and the term flipping, I think, has some leftover negative connotation from 2003, 4, and 5, where you literally would buy a home, do next to nothing to it, remarket it, and make a profit based on rapid appreciation. And now that has happened in the last several years. There were opportunities to buy foreclosure properties in 11 and even 12 and do very little to it, maybe just paint and carpet, turn around and sell it for a profit, and many, many people did. There was easy money being made in real estate flipping, if you want to call it that, in kind of the peak of the foreclosure activity. But in the last year or so, in most of 13 and 14, so-called flipping has really been people who were buying property that needed to be remodeled and made significant improvements to them, adding real value to a property that was in an established neighborhood, putting it back on the market and making a fair profit. And that is an activity that has been going on for decades.
Well, it helps everybody, really.
Mm-hmm.
Yeah, it's not something that's new to this market. And so to recap, really, the easy money has been made in real estate. We have, in most neighborhoods in the Bay Area, we've bounced back to very close to, if not in some neighborhoods, over the peak in 2005. In many neighborhoods, there's still a ways to go. But the easy money's been made, and that's a good thing. Again, I don't believe in buying property, fast appreciation. Really, that's silly and foolish, and it's not a healthy market. But the rehabbers and contractors out there who are buying homes that might not have been remodeled in 20, 30, 40 years, or even since it was built, those people are creating new inventory, new turnkey property that's in demand by home buyers today. That has been and always will be a profitable enterprise.
So here's our thoughts for the day. At 120 miles per hour, a Formula One car generates so much downforce that it can drive upside down on the roof of a tunnel. I don't know if they've ever tried that.
Whoa,
But that'd be kind of interesting.
don't do this at home.
Yeah, don't put on the brake either.
I saw that in Men in Black, isn't it?
Oh, maybe. I've seen it, I'm sure, on some
Few
kind of
movies.
space movies or something. Okay. And this is a very important fact to know. All Major League Baseball umpires must wear black underwear while on the job. Now, who checks that stuff?
Exactly.
And then why do they need, I guess,
Why?
pink underwear would show through the black? I don't know. Anyway, supposedly it's very important. Tune in next week to The Best of Investing. We're giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.